All right. What is up, everyone? Very excited for today's video. I wanted to go over many different things in today's video. We'll go over the advanced decline line here, making new all-time highs, what that means for the market. We've got to take a look at the performance of the equal weight versus the market cap weighted. There's a signal that we're getting right now that is going to be a big signal throughout the end of the year in terms of performance of the equal weight and the market cap weighted and which one is going to perform better. We'll talk about market performance after the Labor Day holiday. We'll talk about how the S&P 500 has seen its longest run of monthly gains since March. And then we will go over September seasonality and what the market data is for September and how it is the worst month of the year for the stock market. So we'll take a look at many different data sets, surrounding that information. All right. We'll take a look at an election year, September. Okay. So we'll even go over, what the September month does in an election year typically. And then we'll go over some more seasonality, especially when it becomes to an election year where we're at currently. We'll talk about how election years are different than other years. And, that's something very important to know when you take a look at performance. And we'll talk about how the equal weight S&P 500 is making new all-time highs here, right? This is a chart that we showed previously, the head and shoulders setup in the Magnificent Seven, and the setup that we had in the equal weight was much different. We saw the equal weight breaking out. So we'll just kind of touch on that some more. We'll talk about the value line geometric index. This is basically what the average stock in the stock market looks like. And then we'll go over where money's been rotating into, right? Where money's been flowing in, where money's been flowing out of, different things like that. We'll talk about the transports, which I think is going to be one of the most important sectors to keep an eye on into the end of the year. And we'll go over what I'm seeing in biotech here as well in relationship to these other risk sentiment type measurements. Biotech looks really interesting here. And we'll also go over the risk on and risk off ETFs, basically describing the differences in difference in performance between those. We'll take a look at some growth versus value measurements in small caps versus large caps. Why the dollar is going to be very important. It can either be a big tailwind or a headwind for us moving forward. And we'll go over the relationship between oil futures and the stock market and really just give you guys an overall good summary of what's going on in the market, what you need to pay attention to, and what charts are the ones that you want to keep paying attention to for the rest of the year. So it's going to be a great one. Be sure to smash that like button, subscribe to the channel if you guys are new. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I just started a completely free newsletter called Investment Intelligence. In there, I'm giving out free, valuable finance and trading related content. You can subscribe to that. It's completely free. There's a website associated with it, so you can go back and review some of the previous articles. I also try to sprinkle in trade ideas in there as well. So you can really, just see for yourself if it's something that you want to subscribe to before signing up. Now, I have extended the Investment Intelligence promo code, which is summer, in accordance with Labor Day. So that'll be going on throughout the rest of the week. After this week, that promo code will be over. That'll get you into our private trading group. Inside of there, you get 20 plus swing trade ideas every week, custom scripts and indicators, exclusive intel, exclusive chart layouts, many of which we'll cover in today's video. And you even gain access to the new products that I just recently launched, the Zone Finder and the Pulse Radar, which are meant to, find stocks that have actionable trade ideas that you can trade and look for results, in as little as 1 day to a week. Or for the Pulse Finder, the Pulse Radar, it's a little bit longer term, but still short term relative, right? These sometimes they take a week, sometimes they take a month or two. This is what they'll look like inside of the Discord. You'll gain access to the full list along with a detailed technical analysis. It's really great stuff. The very first, the launch of the Zone Finder, I went ahead and put the very first trade idea from there into the Investment Intelligence newsletter. And you guys can see that play went up over, well over 100%, hundreds of percent on the weekly call options, and over 70% on the monthly call options. So if you're interested in that, remember the newsletter is completely free. Otherwise, you can use that promo code SUMMER to get into the Discord, the private trading group, and that'll get you in for just $1 for your first month. That way you can come in, see if it's something you want to stay, be a part of, or leave. Now, let's get into the video. And as I mentioned here, we've got the New York Stock Exchange advanced decline line hitting an all-time high. Now, if you remember, we also talked about the equal weight S&P 500 making an all-time high. So this really just goes to show you that market breadth is expanding, and that's good, right? That is very healthy. That is the lifeblood of a bull market, is to see rotation. Okay, and so while we did have that very big drop in the beginning of the month that affected most of the stocks in the stock market, we have seen a very strong rebound in many of the stocks, and especially the big mega cap tech stocks. But if those were to start rolling over, okay, which is a potential possibility because of the performance of September, as we'll dive into later, it's really not the end of the world, because a lot of that is being rotated into, right? And we're going to go over some charts later that are going to show some of the sectors that are being rotated into. Now, this right here is going to be our equal weight versus market cap weighted S&P 500. And as you can see, this downtrend line here looks like it is on the verge of breaking out. So the question is, how do I play this, and what does it mean for my portfolio? Well, it just means that, the other stocks besides the top 10, 20, 50 market cap weighted stocks in the S&P 500, those have the possibility to start performing better than those top mega cap companies. If we take a look, the gray highlighted areas here, the shaded areas, this is August through the end of December. Okay. And so that's exactly where we're at right now. We're in that August to end of December period. And you can see that this line went up this time, and it also went up this time. As this line is going up, this means that the equal weight is outperforming the market cap weighted S&P. Now, what's really significant about that is that in all of these periods, either before or during, we saw the equal weight rolling 8-day performance versus the S&P 500 market cap weighted crossed above 10. Okay, so each time it's crossed above 10, we were in these periods here, and this is when we saw that significant performance, basically in the last quarter of the year, in the equal weight versus the market cap weighted. And I think that that's a strong scenario, a strong possibility for this year as well, given that the rolling 8-day performance, all right, of the equal weight versus the market cap weighted did again cross over that 10. We are in that period from August through the end of December, where typically once this has happened, we've seen an outperformance in the equal weight versus the market cap weighted. So that is something that I believe in. Now, market performance after the Labor Day holiday. This is just some statistics here going back to 2003. So basically, the past 20 years or so. And nothing crazy. Okay, this isn't the main summary you want to take of this is going to be these lines right here. Okay, so the average performance of the Dow Jones on Tuesday is slightly red. All right, on Wednesday, slightly positive. For the S&P, slightly positive both days. For the NASDAQ, slightly positive both days. And for the Russell 2000, slightly positive both days. But when you take a look at this, the percentage up, it's really hit or miss, guys. I mean, the Dow Jones on Wednesday, the Wednesday after Labor Day, has the highest odds here at 66.7%. So if you're an odds person, Wednesday for the industrials, for the Dow Jones Industrials average doesn't look terrible. That looks pretty good. But everything else, I mean, you're at 42, less than 50% on the Dow Jones, on the S&P, barely above 50% on the NASDAQ at 57 and 52%. And then for the Russell 2000, you're at 52 and 57%. So, I mean, those are basically all a coin toss, with the exception of the Wednesday after with the Dow Jones Industrial. So, I wouldn't be looking, too short-sighted, right? That hey, we're 100% going to rally on, Tuesday and Wednesday. It's your typical average day, right? There's not too many insights in that. Now, the S&P has seen its longest run of monthly gains since March. Okay, stocks are up for their 4th consecutive month. I know it seems hard for that to seem possible, given what people are calling like the new Black Monday with the the yen carry trade and the quote unquote disaster that happened there. But the reason I'm pointing this out is because we could be due for a red month. Okay. It's not very common for us to just consecutively just have nothing but green months in a row. All right, we are close to our previous streak of 5 here. We're at 4, so we could extend that streak, to 5 or past 5. But would it make sense for us to start to see some type of a pullback? Yeah, okay, yeah, and that's not doing really any technical analysis. That's just kind of looking at some of the historical odds. Now, when you take a look at S&P 500 monthly seasonality from 1928 to the present, this is from Bank of America, I believe, right here. So after a positive seasonality from June to August, September has the weakest seasonality of all 12 months of the year, with the S&P 500 up only 44% of the time on an average return of negative 1.2%. While October has had its share of downside volatility over the years, the S&P tends to have a Q4 October to December rally, which that aligns very well with election year seasonality. We'll get into that some more, but as you can see, this is going to be the month of September right here, and this one very often tends to be the worst month of the year for the stock market. This is another data set right here going back to 1948, so this one went back to 1928 to the present. Here we have, dating back to 1948, the S&P 500 in September sees an average loss of 0.7%. So again, you're seeing that this is typically one of those red months. Now, these aren't things to live or die by. These aren't things to, shorten the market hand over fist with. February typically is a very bad month as well. And this February, February in this year, I was kind of expecting a pullback, and I think that the market still extended up higher. Now, the S&P 500 faces tough seasonal trends. This is from Bloomberg now. The index has slumped 4.2% on average in September in the past 5 years. So if you notice, what we're doing is we're bringing the data set up more to the present, right? This thing goes back all the way to 1928. Still shows you that September is really bad. This goes back to 1948. This goes back to the past 5 years. And in the past 5 years, the index has slumped 4.2% on average in September. This is via Bloomberg. So, it's possible that we could see a more significant pullback in September than those 1 or 2%, charts that the other one suggested. Now, this is an election year, September, which is what we are in right now since 1950. And on average, all of these are down except the Russell 2000. Now, what's interesting about the Russell 2000 is that market cap versus the equal weight versus market cap weighted chart that I showed you guys, because what that suggests is that you're going to see a lot more participation from the mid and small caps. And we know that the Russell 2000 is that small cap, basically index, right? ETF. And so here you can see that the only one that's positive with the average percent is going to be 0.4%. That is going to be the Russell 2000. Okay, now let's move forward and let's talk about this election year seasonality pattern. So you've got all election years in blue. Okay, that's going to be right here in the middle. And you see that, heading into September, which is where we're at right now, you tend to get a peak. Okay, and then September can be pretty choppy. We start to see a decline, and we tend to bottom out towards late October. All right, this is for all open field election years, which is one of the type of election year that we're in right now. And you see the same thing, except you see a more dramatic pullback in September. Okay, so here, much more, dramatic pullback in September and October, where here it's much less aggressive of a downtrend. Now, these things don't have to play out perfectly, okay? But this is something that, I do think is a possibility. Is that we are going to see some pullbacks, heading into September and heading into October. What's very interesting is that both of these bottom at the end of October. And the reason for that, and a reason, that a narrative you'll see why the market is selling off, is because the market does not like uncertainty. And so it doesn't matter so much if it's blue or red that wins the election. It more matters of, all right, well, investors are unsure where to, if they're making, multi-year long investments into the next election cycle, it would be helpful for them to know, what bills, what things are going to pass essentially, and what parties are going to be running, blue or red. So that way, they can invest in some of the things that may be getting benefits or, stimulus from the government. And so you'll see a lot of, not really too much buying pressure before the election, but after the election in late October, you always tend to see a bottom. Okay. Now, whether that bottom results in a strong rally to the year end, like it does in all election years, or whether it results in a little bit of a dead cat bounce that comes back and retests those lows, that'll be yet to see. But for me, I'm very interested in, taking the time, not rushing thing over the month of September and really looking for names that I want to own if we do get a dip heading into the election and before the election in October. I want to have a good list of some names that I want to, add to my list and potentially buy for a potential year-end rally and bottom after the election. So that's kind of my take and my perspective on it. Election years are different. If we look at the average Dow Jones Industrial Average monthly return since 1896, you can see all years in kind of this blue color and all presidential election years in orange, and it's much more volatile, okay? That essentially is what we're looking at here, okay? We see when the gains are up, they tend to be far more significant, right? Such as these two show. And when the losses are, when we're seeing losses, we tend to see, pretty large losses relative to all of the other election years as well, right? So we tend to see outsized performance, whether it's to the upside or downside when it comes to this volatility. And I expect that to continue. So just keep that in mind. Now, we mentioned earlier the NYSE advanced decline line, making new all-time highs. What that is the number of stocks advancing versus the number of stocks declining. That hit an all-time high. Here, we're taking a look at the equal weight S&P 500 hitting an all-time high. You guys know back in July and even in August, I was talking about how great the setup in the equal weight looked and how it looked like, it was going to go and make all-time highs. And we're very close to our price target up here of 176.50. Now, we also talked about the Magnificent Seven. What's I would say significant here is if we take a look, the week to date change. So the performance last week was negative 0.4%. When you look at the equal weight, right, we actually had positive week to date returns of almost 1%, 0.92. The month to date, right, the equal weight is outperforming the Magnificent Seven on the month to date. The only place where the Magnificent Seven is outperforming is on year to date performance, up 36%. Meanwhile, the equal weight is up 11.42%. So, when we look at things right now, we were seeing warning signs, right? We had our neckline here for this head and shoulders pattern, right? We had the left shoulder over here. We had the right shoulder over here. We knew that if we, came through here, it was very possible that, we could see a drop back down and, see a huge move to the downside. And the one thing that I like to say is that price often precedes news. And so this setup was already here before the Japanese, the yen carry trade. And you can see this is August 5th right here. And that was really the completion of this head and shoulders. And once we did that, of course, the narrative was, things are about to blow up, yada, 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 huge recession coming. But you see, we actually bottomed out there and, went on a very strong rally afterwards. But the short setup was already there, telling us, hey, we don't necessarily want to be overly aggressive going long in this area as we're forming this right shoulder. Maybe perhaps instead we wanted to be looking at the equal weight, right? And so, we can see that the equal weight has recovered from that to make new highs while the Magnificent Seven stocks have not. Now let's continue moving forward. Let's take a look at the value line geometric index. This one is looking good here as well, setting up a nice little bull pennant, bull flag formation, whatever you want to call it. You see the primary trend is upwards here. And now, we're forming this triangle here, this nice little pennant. We'll see if this can break out to the upside. Remember, the value line geometric index is basically what your average stock in the stock market is doing. It's kind of like another way of looking at something like an equal weight, right? To give you a better sense of market breadth versus just seeing that a market cap weighted index and how those are being carried by the biggest names. Now, over here, what we've got, okay, is going to be money flowing in on the top line. All right, this is money flowing in up here, and we've got money flowing out over here. And we see that money's been flowing out of technology. It's been flowing out of technology for the whole month of August. All right. And money has been rotating into these right here. We've got financials, okay, utilities, healthcare, energy, materials. Healthcare, we've been playing a lot of healthcare names in the Discord. We charted up Eli Lilly amazingly. NVO, Novo Nordics, even more, right? Even we've been playing Viking Therapeutics as well as Johnson and Johnson. UNH had some really good setups. The ETF itself, XLV, had some nice setups. Financials, I think are going to could potentially be one of the top performers heading into the end of the year. We'll see, and that's a little bit based on the Fed rate cut. And then perhaps benefiting from a Fed rate cut. We'll see about that. Energy, all right, materials. We've also got industrials up here. Okay, so industrials, the money flows have kind of just been chopping around sideways here, but you can see over the past month, right? This is the line for it. Money has gone from flowing out of industrials back into industrials. So, these I think are the sectors that you guys want to be paying attention to right now. Financials, utilities, healthcare, energy, materials, industrials. Okay, those are the sectors that you want to be paying attention to, for some shorter term opportunities and potentially for a year-end rally. Those are some areas where you could be looking for some nice setups or opportunities. Now here we're going over a little bit of the Dow theory. We've got Dow Industrials on the top, the transports in the middle, and then we've got the S&P 500. What is the Dow theory, you may be wondering? Well, basically what it's stating is that if the stock market, right, the Dow Industrials are doing well, then the companies that are transporting all of the goods and services should be doing well also, right? And so that would be your transports. And the transports have been a laggard. Okay, we've seen this divergence, really since last year, since last summer, where transports topped out, and industrials continue to climb, make new all-time highs. The S&P 500 continue to climb to make new all-time highs. The transports have not even made a new all-time high yet. Okay, so this is one that's been lagging. But if you take a look, this one's starting to break out here. Okay, we've played some transport stocks in the newsletter. We played some transport stocks in the Discord. We had some good ones. C.H. Robinson was a really nice play. There was CHTR. I think maybe that was a transport. I can't remember, but that was another good play from the newsletter, free trade idea. And a few more, right? We played a couple of the transports over the past couple of months, but now I want to see, can this really break out? If this can break out and start to head towards new highs, right? And really get above 1700, that's going to be a very good sign for the overall health of this bull market. Okay, maybe not so much technology stocks, maybe not so much Tesla, for instance. Okay, but this is something that could lead to signs of a healthy bull market and healthy bull market continuation, because you want to remember that rotation is the lifeblood of a bull market. So if we're seeing these things and we're seeing transport start to rally, then whenever those start to cool off and money gets transported out of the transports, we can see some of that perhaps flow back into technology, communications, other things like that. Now, what we've got here is a good way that I like to look at risk sentiment, essentially, in the stock market. So I'll break this down for you guys pretty simply. Nothing too complicated here. We've got the S&P 500 on the top. This is going to be your stock market. We've got high beta to low beta stocks, okay, to low volatility stocks. We really wanted to see this thing break out, man. I mean, we really wanted to see this thing break out, but this has instead rolled over. The discretionary to staples ratio has rolled over here, and the credit spreads also rolled over here. These making lows, lower lows, lows, lower lows, lows, lower lows, while the stock market's been making lows, higher lows continuously. Now, biotech is the one that actually looks really good and has been improving. So biotech is another sector that I think you guys can keep your eye on. There's a lot of talk about these, Ozempic related drugs, these weight loss drugs, and they're really catching fire. And it's still a very competitive race in these. Okay. And there are very small, biotech companies, working on things that can go up massively, right? Not even just related to those weight loss drugs, but that's how a lot of these biotech companies work. Is a lot of times they're spending lots of money, and they're unprofitable companies because they're spending so much money on R&D trying to develop some type of drug that will get FDA approval and make them insanely profitable, right? Another perspective of why a biotech perhaps looks so good is because of the potential rate cuts that the Fed has signaled most recently at Jackson Hole. Right? Think about what I just told you guys. Biotech companies are oftentimes profitless companies just burning tons of money. So what does that mean? They have to take out loans, right? They have to borrow money in a high interest rate environment. Not only are the lending standards tighter, but it also costs these companies more money to borrow. So with rates coming down, this could be a potential rate cut play here as well in the biotech sector. When we talk about things that are standing out to me, what the market is telling me, when you look at all the things that the market tells you, it's telling me to definitely keep an eye on biotech, and I think you guys should as well. Now here we've got a risk on ETF. This has got copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. You can see that this stock has not really flipped into a long-term downtrend, but on the shorter term, we have lows or we have highs and we have lower highs right here. Okay. Meanwhile, in the risk off ETF, this one has just continued to climb nonstop throughout the year, making new all-time highs here recently. And this is going to be comprised of gold, U.S. Treasury bonds, the yen, utilities, and staples. Now, when you look at growth versus value, okay, growth stocks really haven't been looking too great. I mean, whether it's in the Russell 2000, whether it's small cap growth versus value, or large cap in the S&P 500, I mean, they're basically round tripping their performance back to the levels that they were at in the beginning of the year, right? This is early January right here. We're seeing that these ratio charts are back towards these levels where they were in the very beginning of the year. They are off of those lows or off of those previous highs. They are higher, but still overall, they look much different than the chart above, right? Of the S&P 500 that's been continuously making higher highs and higher lows. It's a much different story here when you take a look at the relationship of growth versus value. Now, here we've got the S&P 500 versus the dollar, all right? And so this is either going to be a big tailwind or headwind for the stock market. You know, basically these two move opposite. So, you can take a quick example of that, right? It's not a coincidence that the stock market bottomed the same time that the dollar peaked, right? We see this, the dollar rising here, and we see the stock market going down. Here we see the dollar dropping, and we see the stock market going up. This is their normal relationship, right? And now when it diverges from their normal relationship and we see, the stock market going up while the dollar is going up, we had a 4-month divergence heading into, before we saw the bear market of 2022. And that led to a massive rug pull in the stock market. And we pointed out the most recent 4-month divergence in the beginning of year in April. And we got another little mini rug pull here, right? I know a lot of people remember that April pullback seemed like it came out of nowhere and it was very fast and aggressive. But on the channel and in the Discord, I've been highlighting this that, hey, we literally are right back at another 4-month divergence. And the last time we saw this, we saw a significant pullback. Now, of course, we didn't enter a bear market. That's why we didn't continue pulling back as we did over here. But we did see a strong pullback right here. And currently, we're seeing the relationship do what it's supposed to do. We're seeing the stock market continue to go higher while the dollar is dropping here. So if the dollar can completely roll over and essentially get below 100, that is going to be a headwind for the stock market. And again, it may not be the best for all of the equal weight stocks or for the market cap weighted stocks. But what we are seeing is that market breadth expanding, whether it's the advanced decline line or whether it's, the equal weight versus market cap weighted ratio chart. It does look like we're going to start getting that broader participation from other names in the market. This is another one it could be a potential headwind or a tailwind for the market. Kind of the same thing. All right. You're going to see oil futures typically move in the opposite direction of the stock market. So you can see when oil futures were rallying strongly here, we were having a strong decline in the stock market. As the stock market's having a nice uptrend, we're seeing a nice downtrend in oil futures. Same thing over here. Oil's been in a downtrend. We're making, highs, lower highs, lower highs, and here we're making, you know, highs, higher highs, higher highs. So, you know, definitely want to keep an eye on the oil and the dollar. If those continue to roll over, that could be a tailwind for the market to keep climbing higher. But if we start to see some rises in those and we start to see those spike up, that could lead to, you know, some market volatility perhaps. Yeah, so that'll wrap up today's video. Hopefully you guys enjoyed it. Okay, smash the like button, subscribe to the channel. Don't forget you can sign up for that newsletter completely free. Check out the link in the description to sign up for that. Review the website, see if it's something you guys are interested in. And you can use that promo code SUMMER, okay, to get into the Investment Intelligence Private Trading Group for just $1 for your first month. Okay. You know, in there, 20 plus swing trade ideas every week. You get access to custom scripts and indicators that I've made, exclusive intel, exclusive chart layouts. You'll also get access to the zone finder and the pulse radar. That's only if you join right now. Those are going to be separate coming here soon. VFC, this play is still in this one. This one just hit over 200%. Ford got out of Ford around 35%. PCG was very, very nice. That one just exploded here recently. You know, massive gains on that. BMY when you know, did absolutely massive, magnificent. ConAgra. So many different trades, guys, coming from the Pulse Radar longs, coming from the Zone Finder longs. Those are two new tools that I've added to the Discord. You know, and on the debut of those, right, I put in one of the free trade ideas from the very first trade idea from the Zone Finder, not the Zone Finder spit out. And that one returned some really massive gains here. So, you know, looking forward to seeing you guys in there. Okay. If you have any questions when you enter the Discord, feel free to ask me. I'll be very glad to help you out. There's a dedicated room in there just for questions. You can also leave questions in there. And if you ever want to do a one-on-one session, right? Maybe you want a coaching session or you want that personal one-on-one touch, you guys can go to my Ko-Fi page, click on the commissions tab, and in there you can book a 30-minute or a 1-hour session. You can do that directly through the Ko-Fi page, or you can click on this buy a coffee button, basically a way to leave a tip or donation for all the free valuable content that I do put out, such as the newsletter and these YouTube videos. All right. Appreciate you guys watching again, and I'll see you in the next one.